now to Mr. Peter from our Baraka Banking Group, who is the Senior Vice President, Head of Credit and Risk Management. And we have the privilege of getting the views of maybe around 13 jurisdictions, so this is the good thing. Mr. Peter, yes, the floor is yours to give us your...
Thank you very much. First of all, I also want to say good morning and thank you for being invited onto this panel. And our Baraka Banking Group is very happy to share the ideas on Basel III and our experience with Basel III so far. Now, the first thing is that I didn't prepare a detailed presentation like my colleague here, but just give you a few broad outlines on the Baraka Banking Group, because Basel III implementation presents special challenges for our banking group, because we have 12 banks operating in 13 jurisdictions, and as you may know, some of you may know, we have 5 banks in Africa, 4 banks in the Levant, 1 in Bahrain, 1 in Pakistan, and 1 in Saudi Arabia. The Saudi bank is an investment bank, so it would not be necessarily impacted by Basel III. But all the other banks are what we would call deposit-taking and lending banks. Therefore, they are very much into the Basel III focus. Now, just a few words about ABG Group. ABG Group is possibly the most international banking group today, Islamic international banking group today, with $21 billion in total assets and $2.1 billion in capital funds. The bank has almost 500 branches in all these countries and a total staff number of 10,000. So it's a very considerable, large bank, which is further expanding and looking at future both geographies in countries where it is not present and also deepening its presence in the existing countries. So Basel III implementation is, as I said, a very special challenge when you have so many banks, and the jurisdictions, other than Bahrain, are working at a different timetable in implementing Basel III. We know the Bahrain regulator, central bank, whose representatives are here and who do a fantastic job in ensuring that we are all ready for it on January 1st, 2015. However, other than 2 other subsidiaries, namely the one in South Africa and the one in Pakistan, who started already respectively 2 or 1 year ago, and they are in the process of implementing Basel III. All the other units we have are just about to start, or not even set a date for it. Just quickly, I forgot to mention that our largest subsidiary, which accounts for about 80% of our total assets, come from Turkey, Jordan, Egypt, and Algeria. These 4 subsidiaries account for almost 80% of the total activity of the group. Now, out of these, I'm happy to say that in Turkey they will introduce Basel III starting 2015. In Egypt, again, starting 2015. And I checked with EAD, and in Jordan, there is no date yet set, but there are plans for it. So, if I look through as to how we implement Basel III, the first thing is that I look at my local regulator, Bahrain regulator, who looks at the consolidated reporting and consolidated requirements of the group. And I need to meet that as ABG. And in that regard, we had, as I said earlier, we had early preparation for Basel III. The challenge was identified already in 2012. We formed a committee for this, and we have been drawing together the ideas and solutions. I just want to highlight what were the main issues that we brought up in implementing Basel III with respect to capital and also with respect to liquidity. I think one of the capital-related main issue was how minority interest is treated in calculating capital adequacy ratio. Clearly, for our group, which has 1/3 of its consolidated capital in minority interest, it was vital to know whether minority interest will be deducted or not in calculating the capital adequacy ratio. And the directive from Bahrain, central bank, the Central Bank of Bahrain, rightly identified that the minority interest is not to be deducted as long as the minority interest is invested either in common equity tier 1 or tier 2 in the respective subsidiary. So it performs that role that we expect the capital, the high quality capital to perform. And consequently, ABG is today, we already calculated several months now, our pro forma capital adequacy ratio is 16, just over 16% in its Basel III capital ratio calculation, which is quite close to what it was, because it was just around 15.5, 16% also on Basel II basis. So that was one issue. The other issue that concerned us very much in preparing for Basel III was how alpha will be treated, whether there will be any change in alpha. If I may explain to those who are not familiar with this, here under our fee and Central Bank of Bahrain directives, assets which are funded by the unrestricted investment account holders' equity those assets don't require 100% capital backing. The risk-weighted assets that are funded by Urias require only 30% capital backing. We call this 30% the alpha factor. And that remains. So for us, that was very important that it has not gone up, because clearly it would have again changed the capital calculation that Basel III will require. Another point briefly regarding capital still was to do with the restriction that is in the Basel III regulations in Bahrain relating to tier 2 capital, namely 2% of the total capital and 50% of the common equity tier 1. We raised this, in the consultation process, we raised this with the central bank here and said, should we not increase somewhat the percentage on this restriction, because we see more and more Islamic banks going to the market and looking at the tier 2 capital as another source of strengthening the capital base. Today, tier 2 capital, as we heard in the case of Arab International Bank, is not that significant, neither is it for us, only a few percentages. But as we move on and we are putting this system in place for the next 10, 15 years, it may become important also for Islamic banks. Unfortunately, the Central Bank of Bahrain, in the consultation process, so far said that these restrictions, that is the 2% and 50%, remain unchanged. Finally, again relating to capital, we thought about talking about, sort of asking about introducing the capital conservation buffer, the 2.5%, more gradually, but this was again declined. The reason we wanted this buffer to be more gradually introduced, because we felt maybe there is time given for the banks to increase their capital, as it would have reduced the available capital, because it's 12.5% today, they said no, you don't get a reduction as a result of Basel III in the requirements. So that's it. Now, the liquidity-related issue. I agree with your speakers that liquidity indeed is one of the key challenges for Islamic banks. As far as our group is concerned, and we have started to monitor both the liquidity coverage ratio and the stable funding ratio now for 2 years on a pro forma basis with our subsidiaries. It seems that the Baraka banking group would not face any major challenges. Why? Because we are local banks in all the countries, and in the past year particularly, the past couple of years particularly, we increased our dealing with the governments, the central banks. In countries like Turkey, Egypt, Jordan, we have a very large proportion of our liquid assets in governments. And these government assets, sukuk or other eligible government paper, which we can as Islamic banks hold, are, as it was pointed out, ready liquidity. And so when I look through the LCR ratio in the subsidiaries, in all cases, almost all cases, we were fine. Pakistan is the same. We have also a large holding of Pakistan government sukuks. So, but in the future, how we tackle this is another issue. And we have to think again forward 5–10 years from now. I believe that this idea of a liquidity fund created would make sense in many of the jurisdictions where we are. Just quickly to make my notes here, going back briefly on the capital adequacy.
Maybe just one more minute.
Yeah. Going back to the capital adequacy, Baraka banking group subsidiaries started to look at the so-called subordinate sukuk markets. And while today, as I said, we are comfortable both with a consolidated capital ratio of 16%, but in individual countries, Turkey, Pakistan, and South Africa, we started to look at the possibility, or actually already implemented, subordinated sukuk issues. 200 million in Turkey, which was extremely successful for 10 years. And also recently, just a few weeks ago, we did one in Pakistan, which was also very successful. And we are planning more to do. This is in preparation for the future when the capital requirements of the group, as the group grows, will be more important, more and more necessary. Finally, as another reaction to the management challenge of dealing with capital requirements in Islamic banking, about 18 months ago, we introduced throughout the group, on a pilot basis so far, but I think we will roll it out on a compulsory basis, the calculation of what we call a RAROA, risk-adjusted return, that is larger transactions, as they are processed and approved, will have to be reviewed, what is their use of capital, and compare the return after deducting the cost of capital from the proposed profit out of the transaction, out of the credit. And this has become very significant as a tool to indicate throughout the group, into the management, that when you do transactions, think about the importance of capital and how much capital will be used in each of those cases.
Thank you, Peter, for this insightful information. Maybe, I think we will leverage as much as we can on the audience and maybe give you the opportunity to ask questions if you have any questions. Please, to address our panel. Yes, please identify yourself and your organization.
My name is Baraka.
Can we have a mic, please?
My name is Baraka. I am CEO of Trident Financial Accounting Consulting. We are a banking consulting firm. My question to Mr. Fadi about this fund. Could you please explain a little bit how this fund works in terms of returns? Obviously, is it doesn't give any returns to the contributors of the fund, and how the people who borrow, the banks who borrow from the funds, how are they rewarded for it?
Yeah. Yeah. The fund has a net asset value. That's number one, because it holds, it has an investment policy. Investment policy stipulates in it within how much percentage would that be invested into various kind of bonds or sukuk available in the market, plus cash. The cash component, which is calculated based on historical trends of requirements the central bank has provided as in a trend, what is the maximum withdrawn at any time, any particular bank, at any time period over 2 years. And then at that stage, the calculation has been done on how much asset cash should be maintained and how much is the investment. So there's an investment policy attached to that fund. This is number one. Number two, daily basis, a NAV is issued to all banks, and included in that is the asset components of each of the assets under that fund. So there is a pricing for that. For example, the unit price could be 1,000. Tomorrow to get 1,001, day before 999 or 998, depending on the net asset value of that fund. Plus, any bank who wants to redeem part of his share for liquidity reasons, he will pay a fee, and that fee is also an income to the actual fund. So the manager of the fund has his contribution, and his performance is managed or monitored. It's monitored. Accordingly, he will take fees based on that performance. Plus, there's the NAV, which is a profit that is distributed to all the members. Plus, there is a fee on the redemption on a requirement per bank or per institution that wants to participate into this. So this is the concept in general.
Thank you, Fadi. Any more questions? Yes, please.
My question is, what are the expected role for the virtual group for Islamic banks to cope with or to implement Basel III?
Perpetual sukuk. Want to take this, Andrew? Maybe can read some brief points on this. Actually, there are some kind of has been a trend in issuing some tier 1 or tier 2 sukuk, and this perpetual sukuk can fill into this gap of requirements, but still there are some uncertainties, and this goes same line with comments mentioned by Peter. Do you want to any comment on this subordinated sukuk or perpetual sukuk that will target to respond to the regulatory requirements from tier 1, tier 2, and so on?
The experience with these issues in two of our subsidiaries in Turkey and Pakistan so far is that we obviously felt if there is a way to raise finance through sukuk, which the local regulator fully is happy with and treats it as tier 1 capital, in fact, in case of Turkey, I know for sure, then why should we do it? And we were very successful with it for 10 years. They issued it for a 10-year tenure. The other bit we did in Pakistan also was in order to make sure that the capital adequacy of that bank we have in Pakistan is met. And again, obviously, the regulator had to approve it. Now, because we are a consolidated group, there was a further requirement that also here in Bahrain, these become eligible for capital calculation. So we have to go through 2 steps.
I think the key issue is the regulatory treatment. There's no point doing it unless you're going to get favourable regulatory treatment. So one has to look at how it's treated by individual regulators in particular jurisdictions. The broader point I'd make about it is it's an untested instrument. We don't know how it will behave in a crisis. I mentioned in my presentation, some of the hybrid capital instruments that were issued by conventional banks in, say, 2003, 2004, 2005, turned out not to be able to absorb losses when they needed to during the global financial crisis. So as an investor, my question would always be, well, what will these instruments be absorbing losses or not if there is a crisis, that they are untested?
Thank you, Andrew. To this I may refer you also, there was a nice report issued by our friends from the IFM, International Financial Markets, which deals with some case studies on subordinated sukuk and other T1, T2 sukuk. Any further questions? Yes, please.
From our director. I agree with the notion that Basel III does not actually pose too much of a challenge to Islamic banks. But what I'm worried about is the general trend about the regulation, the way regulation is going, the way the interaction between financial institutions and regulation is going. I mean, things like bail-in and resolution schemes, categorization of your liabilities according to loss absorbing capabilities, those are going to be much more challenging with regards to Islamic finance than Basel III, for example. And in an environment where capital is becoming more costly, regulatory-wise and financial-wise, and regulators are requiring banks to be much more simplistic and much more intermediary in that way, while Islamic banking is becoming much more structurally more complex. That kind of trend, that kind of divergence is going to be much more problematic in the future rather than the Basel III itself. And I just want to know what the participants think about this.
Okay, thank you. Anyone? Andrew? Okay.
Yeah, I think that's I think it's an extremely good point. Thank you for raising it. And I think there are various aspects there. One is that the regulatory agenda is being set by regulators and to some extent also by politicians. In Western markets, we as taxpayers had to pay large amounts of money to bail out banks, and the politicians that we elect are not willing to do that again. So whereas in the run-up, say in the run-up to the financial crisis, one can say that the regulators had to some extent been captured by the banks. One can argue that Basel II was an agreement between the banking system and the regulators, where the banking system said, okay, we'll implement this very complex thing you're calling Basel II, but we want to be able to have some control of it by using our own risk weights. So there was an element of regulatory capture. That's not the case anymore. In Western markets, after the global financial crisis, regulators have taken back control of regulation, and to a large extent politicians have taken control of it as well. Less of an issue in this part of the world, both for Islamic banks and conventional banks, where that tax-paying community, and dare I say political accountability, is perhaps less pronounced. Set against that, I think there is increasing recognition within global finance of the value of Islamic finance. It's an extremely successful business model. It's been growing for years. It's here to stay. It's getting bigger, and it has to be accommodated within global regulatory architecture. It's always interesting, for example, as I mentioned, that there's a specific reference to Islamic finance within the Basel document on the liquidity coverage ratio. I suppose I better stop there to allow others. There was a third point that just slipped my mind, but go on.
Thanks, Peter.
If I may add my thoughts to this very interesting question. I see what you pointed out as the trends. There's a trends going into two different directions. There is an increasingly heavy regulation of banks for the reasons that we know, which you outlined. But the other side, I think the Islamic banks are now moving, and should be, towards more equity-type finance. They should be getting away from the murabahas and the bank-like financing and moving more towards funds and investment activities. And that has nothing to do with Basel III, or not a lot. So if today an Islamic bank has most assets in equity investments, joint ventures, musharakas. How would is Basel III relate to that? There are issues there, the liquidity, but nobody addresses it. It's not quite clear as to how they cope with the challenges in that area. For the time being, for the next years, I think Islamic banks successfully grow, and the main products probably remain the murabahas, ijaras, and other finance instruments like diminishing musharakas. But once Islamic banks really do investments in agricultural and industrial ventures, how will that impact the Basel III position of the Islamic banks?
To share with you on this, I think IFSB has issued like a revised capital adequacy standard which deals with some of the products, probably, but probably not all the products that are available or that maybe will be available in the future. So perhaps this is something that can be taken on board by the IFSB again to provide more clarifications and clarity on a range of different products and their risk weights, how they should be. Any more questions in the audience? Yes, please, Ijlan.
Just on the regulation, I think it's a small point. It's a good one to answer. But there are two regulations coming in. Some initial assessment, if you do, one is Dodd-Frank in North America, and the other is the EMIR, which is European Market Infrastructure Regulation. If you look at it, impact on the Islamic banks at the moment will be less. Certain transactions will be going to clearing because now they want. So if the bank is, let's say want to hedge the currency risk and all, then maybe if it do it with the G20 bank, then they will probably have problem with how the product is structured, because there the products are defined, the Islamics are not included. So at the moment the Islamic banks, initial assessment may not be impacted, but the more worry is, I think, with the big banks which has windows, because the way they will trade, the margin and the collateral requirement will increase. So these are, I think, regulation for Islamic. Immediate impact may not be there, but for us to maybe make further assessment, and I'm sure we will be working on that.
Thank you, Ijlan. Please.
Al-Hafiz from Singapore. Do you consider gold as a high quality liquid asset class? Why?
Sorry, can you repeat again?
Do you consider gold as a high quality liquid asset class for Basel III, and why?
The rule for the high quality liquid assets. How do we identify high quality liquid assets? Andrew?
Well, I would defer to the Basel Committee, which does not see gold as a high-quality liquid asset. I would need to ask them why not. Coins and banknotes are considered very strong high-quality liquid assets, but not gold as a commodity. And I would assume that the reason for that is the volatility of the price.
Clearly, there is a very substantial market risk with gold, and I think there is some degree of acceptance of gold in calculating high liquid assets in our subsidiary in Turkey under the Turkish Central Bank regulation.
But it's due to the liabilities of liabilities.
But I just wanted to say, but it's not purely the gold, but you replace some of your cash reserves with gold. But it's gold kept in the central bank, and therefore it's a central bank gold account, which is very liquid. It's not simply going into the market to get gold.
Okay, please, you want to add some comments?
I just wonder whether if a regulator is applying the alternative liquidity approaches that I touched on in the presentation. So in a jurisdiction where the regulator says there are insufficient high quality liquid assets, we are going to take advantage of the alternative liquidity approaches, which is in Appendix 2 of the liquidity coverage ratio document, that the regulator could say, well, in this particular instance, we are going to allow gold as a high-quality liquid asset, and there will be certain disclosure requirements associated with that. But maybe that's a route where gold could be accommodated.
Thank you, Andrew. I will give now the floor maybe for some last comments to the panel on the future outlook. How do you see? Optimistic? But I would say, when I hear some comments saying that capital, for example, for Islamic banks, applying Basel III to Islamic banks for the moment is not a problem, I'm a little bit scared of these comments. So meaning in the future we may have a problem. So that's why we want to understand, at least from your side, from your views, now, okay, but what after, and how do you see it? From both capital and liquidity. Any 1 minute speech, if you don't mind. Adi?
Well, I think more or less regulators are being too prudent as far as the regulations related to Islamic banks, and that's why you see that sort of a comfort happening. And I think there's the whole structure of how Islamic banking is done does matter. It's not just the banking side, I mean, as a banking, but also what comes along with the market discipline, disclosures, behavior. Because if it's all about the risk, and the risk in Islamic banks are much more, it's not just the credit risk, it's also the technical risk that's associated with any participation, etc. So if that whole, let's say, structure in handling the risk and participation of the risk comes to alliance with the Islamic mode of finance, I think that's where the maturity happens as far as the market is concerned. And then we move into that structure. How can we be lessening the requirements as far as regulators, etc., and properly assessing the capital requirements for Islamic banks?
Thank you, Fadi. Peter?
I agree with Szalay on this. When we talk about capital adequacy, we talk about risk absorption. It's there to absorb risk, but the first thing is obviously not to hit the capital with the risk by needing capital, but good risk management. And I think the Basel III, but also many other initiatives that are coming now into Islamic banking, which is generally extremely positive, because the recognition of risk, the recognition of how to manage and mitigate it is now very widespread. And I think if Basel III helps in that process, and it does, then it's all for the better.
Thank you, Peter.
Yes, maybe I want to stress upon the same point that I addressed in my presentation. I personally don't think that the answer for Basel III is increasing capital. I personally think, as I think Peter touched upon it, which is we have to have better ways of managing risk and stressing on the control function in Islamic financial institutions, because you have to be able to, if you don't want to touch the capital, you have to be able to deal with the other side of the equation, which is the risk and the amount of risk you want to take. And this, if it's in control and it's controllable to the extent that is required, you will be always in a good shape. And again, I don't think that there is any hindrance of growth. This does not constitute hindrance for growth, because as long as prudent practices and decisions are taken, I don't see any reason why Islamic banks shouldn't grow and flourish in the future.
Thank you, Ayat. Andrew, with these comments after hearing for 1.5 hours from our bankers, have you changed your views on perceptions on the impact of Basel III Islamic banks?
Well, my views have been enriched by the discussion, certainly. On capital, I would say that if we're talking about a minimum capital ratio of 8%, which is the global standard, then I don't think Islamic banks have any problem. However, in this part of the world, there's a tendency for regulators to require higher minimum capital standards under Pillar 1, and that's, by the way, something which I find strange and unwise, but that is a discussion for another day. But that may be a reason, these higher minimum capital ratios may be a reason why Islamic banks find capital a little more challenging than they otherwise should do. On liquidity, the provision of greater amounts of high-quality liquid assets is a structural issue for the Islamic banking industry. There's a lot of work being done, it's being successful, but it's going to take time. So you have local funds, such as the fund in Sudan, you have the work of the IIFM to develop new instruments, you have the work being done in Kuala Lumpur by the International Islamic Liquidity Management Corporation to issue highly rated Sharia-compliant debt, but this is all going to take time. What you can manage today is your own balance sheet. And so I think there will be increasing focus on retail deposits, which have low run-off levels, as Iyad mentioned. And so structurally, over the medium term, I see the focus for Islamic banks being on retail business in order to comply with liquidity ratios.
Thank you, Andrew, and on your behalf, I would like to thank our panel for this enriching discussion. We have a short, small token of appreciation to our panel.